Oh, where do you want to start?
There's a little bit of a market recycle
Yes.
happening right now, right? I mean, we all know that. So much money's on the sidelines. It's very difficult to know how it's going to reprice, how it's going to work out.
And what we're seeing right now is we're seeing a tremendous amount of capital sitting back on the sidelines, not doing a thing. In fact, I've heard this month, pencils down. I go, what are you doing? Pencils down, right? The one variable when debt goes up, cash flow goes up. So that means that you offer less. And so we're having some cap rate issues right now, right?
Everybody defines cap rate like this magical thing different. I see it as a metric of desirability. To me, basically, it's a metric of desirability. So if I'm more bullish on something, I'll pay a higher price, which relative to the income results in a lower multiple, which is the cap rate that we are talking about. So, because everybody keeps saying, why would you buy it at 5 cap if you could buy it at 10 cap? Well, there's a reason for that, because it's more desirable, and that means maybe it's safer, maybe it's got more staying power, however you want to define it, right? Clearly, the interest rates have an impact on cap rate, but so much of it is psychology that it's very difficult to tell. Like, you can't, it's not just math. Some of it is math, but some of it is, okay, I'll pay more because I really want this thing, because it fits, because whatever, right? And that's where we get into, well, do you go into the office space or do you go into apartments? Or if you go into apartments, do you go into 1973 or do you go into 2007? That kind of thing, right?
Historically, if you were to look at, let's say, downtown urban and then more rural, the downtown urban, whether it's a commercial office building or multifamilies, typically have lower cap rates because, of the walkability scores, which are, proximity to things or, where the employment hubs are. So that's typical. And the reason why it's important and the reason why we even talk about it is because a lot of the syndicated money that we're all associated with is based on a cap rate not going up a lot. That's the bottom line. So let's say you buy at a 4 2 years ago, maybe you've budgeted a little bit more, maybe not, but it's, now they're probably north of 5 is what I've been saying. So that's a 20% difference in the sale price. So, and which is being reflected right now.
Absolutely.
In pricing.
And to be clear for everybody, when cap rates go up, the value goes down.
From there, the question is, okay, am I willing to accept negative leverage? So, in other words, if I buy this and I know my interest rate is going to be 5.25, does my cap rate need to be above that?
Right.
Do I need to have positive leverage, or am I willing to put more money down, buy my cash flow, because the asset is so intrinsically strong because of the location, the vintage, whatever have you, right? And then accept negative leverage. So, the books always write about, oh, no, your cap rate has to be above the interest rate. The reality over the last 20 years, that's just not the case.
Not
right?
always, right.
Because what's happened in Phoenix, and I can only speak to Phoenix, because I'm like, I don't even go to Tucson, like we're strictly in Phoenix. We haven't had any difference between a cap rate on a 1983 property versus a cap rate on a 2014 property. Like everything is 3.5 cap.
Wow.
It's like been like that in Phoenix for 5 years. And I've been thinking to myself, like, that's not right, because one is quality here. The other one is quality there. Like, where is the premium for something that's older, for something that's not as well located? Shouldn't there be a premium for that? Well, I think that's what the market is sorting out right now.
That's a good point.
There hasn't been a premium, right? Because everything is value add. We can renovate. We can hike rents on everything. Everything is a function of a delta. We buy at 3.5 cap, we sell at 4 cap, and everybody makes money because our rents are, 70% higher NOI when we get out. Well, that's not the case anymore. And right now, I think the smart money, the reason it's sitting on the sidelines is because it's trying to figure out, how much premium do I want?
Well, I know from my own, and so you do a lot of renos. We do a lot of renos. We had, last I looked, we had around $68 million in renovations. And, we're getting clobbered on our renovation costs. And for a number of things, so obviously labor's gone up, supplies have gone up, paint and drywall and all those kinds of things. But also the availability just to get appliances. So
Sure.
So not being able to get washers and dryers means that you'll pay more for a washer and dryer.
Yeah, $12 million
That's a lot.
going right now. It's easy for us, but we made a pivot toward Class A because we said, listen, if paint is going up, we might as well do it in a Class A unit because we'll get a higher return from a Class A resident.
Right.
Okay? If appliances are getting more expensive, we might as well get Class A appliances. So we spend a little more to get a really upscale package, but fewer people are looking for it, so it's easier for us to source it, and we're going to get a bigger return. So you're going to spend marginally more replacing the cabinets as opposed to painting them, but you are attracting, in that location, in that asset class, you are attracting a much differently qualified tenant profile. And that relates to everything: commercial, industrial, office space. Yeah, there's a big problem with office space right now in Phoenix because so much of it's getting old.
Yeah.
And it's getting functionally obsolete, right? So the Class A locations are still killing it because everybody wants to be there. But the other stuff, I think we're going to have a problem nationwide, really, not just in Phoenix, but so much of it was built in the 80s.
And so what we're seeing, Ben, is we're seeing people, they're negotiating smaller footprints. So maybe they had 10,000 feet. Now they're trying to maybe have 3. Most companies are not going to be looking for more space because even if they're growing as a company, this work from home, this hybrid model is here to stay. Let's talk about the supply, because the one thing that a lot of people don't realize is that, we've really, in the last 10 years, single family and multifamily or just housing is severely undersupplied based on the population growth, right?
Well, that's why we're bullish.
Correct.
On what we do.
That's right.
At the end of the day, like all the rest of it is challenging, but so much of it is noise because at the end of the day, hey, in Phoenix, all of the MSA, if you look in Yardi, I think the pipeline is 32,000 units. All the entire pipeline for everything. How much of that pipeline won't come to be now?
A lot.
The rates where
I think a fair amount.
Okay. So we agree, right? So we need, 150,000, something ridiculous.
Yeah.
Okay. Right now, I'm super concerned because we have a shortage, hence the growth in, rents over the last, before the pandemic, we were still growing rent 7-8%.
Right.
So that's too much for people to afford. Eventually you hit a wall.
Yep.
So we need more supply. That's the way to fix that. Well, now with the rates being where they are, land deals are falling out of contract right and left. Nothing that's not shovel in the ground is being done. Forget the 32,000 units, however many units come over the next 3 years, and then there's going to be another lull because we're not starting right now. Right now, everybody's pencils down, just like you were talking about before. Yeah. So are we moving backwards as it relates to affordability, as it relates to availability of pricing, both single family and multifamily? It's kind of scandalous. I mean, it's a real issue, and we're not helping ourselves right